Welcome back to Personal Finance Simplified. I'm your host, Ishika Chandra, and today is Wednesday, August 19th. Today's episode is all about taxes. Now, I know hearing the word taxes probably doesn't make you really excited. Maybe you've heard your parents complain about doing their taxes every April. Maybe you've started your first job and noticed money is disappearing from your paycheck. Or maybe you're in college and have absolutely no idea what a W-2 or a 1099 even is. The good news is that taxes don't have to be confusing. By the end of this episode, you'll understand how taxes work, what all those forms mean, why you might get a tax refund, how tax brackets actually work, and some common mistakes to avoid. So let's start with the most basic question. What are taxes? Taxes are money that individuals and businesses pay to the government. The government then uses that money to pay for things that benefit society. For example, public schools, roads and highways, police departments, fire departments, national parks, the military, public transportation, and social programs. So every time you earn money from a job, the government generally requires you to pay a portion of that income in taxes. There are many different kinds of taxes, but today we're mainly talking about federal and state income taxes, which are the taxes you pay based on the money you earn. One of the first tax forms you'll probably encounter is a W-2. A W-2 is simply a form your employer sends you after the end of the year. It summarizes how much money you earned during the year and how much was withheld from your paycheck for different taxes. If you've ever looked at one of your paychecks, you've probably noticed that the amount deposited into your bank account is smaller than the amount you actually earned. That's because several different taxes and deductions are taken out before you receive your paycheck. Let's break down what those are. The first thing you'll actually see is gross pay. Gross pay is the total amount of money you earn before any taxes or deductions are taken out. For example, let's say you earn $20 an hour and work 40 hours in 1 week. Your gross pay for that week would be $20 times 40 hours, which is $800. However, you won't actually receive the full $800 in your bank account. After taxes and other deductions are taken out, you'll receive what's called your net pay. Net pay is often referred to as your take-home pay because it's the amount that actually gets deposited into your checking account. Deduction you'll almost always see is federal income tax. This is money that's withheld from your paycheck and sent to the federal government. Remember how we talked about income taxes earlier? Instead of waiting until April and asking everyone to pay one giant tax bill, the government has employers withhold a portion of your paycheck throughout the year. Then when you file your taxes, the IRS compares how much tax you actually owed, how much tax was withheld. If too much was withheld, you may receive a tax refund. If too little was withheld, you may owe additional money. Depending on where you live, you may also see state income tax. This works very similarly to federal income tax, except the money goes to your state government instead of the federal government. States use these tax dollars to help pay for things like public schools, roads, state parks, public universities, and emergency services. It's worth mentioning that not every state has a state income tax. Some states don't collect one at all, while others do. So whether you see this deduction depends on where you live and work. Next, you'll probably notice Social Security tax. Many young people wonder, why am I paying for Social Security if I'm only 20 years old? Social Security is a federal program that provides benefits to many retired workers, people with certain disabilities, and eligible family members. When you're working, a percentage of every paycheck goes towards helping fund the current Social Security system. Then, if you're eligible in the future, you may receive Social Security retirement benefits yourself. Basically, you're paying for the current retirees while you're working, and when you're retired, someone else will be paying for you. You will also see Medicare tax in this form. Medicare is a federal health insurance program that primarily helps people who are 65 and older, as well as certain younger individuals with qualifying disabilities. Just like Social Security, a portion of every paycheck helps fund the Medicare program. Although you may not personally use Medicare for decades, today's workers help support the program just as future workers may help support it when today's workers retire. Depending on your employer, you might also notice other deductions on your paycheck. For example, contributions to a 401k retirement plan, health insurance premiums, dental insurance, vision insurance, flexible spending accounts or FSAs, health savings accounts or HSAs, union dues if applicable. Not everyone will have these deductions, but it's helpful to know what they are if you see them on your pay stub. At the end of the year, your W-2 summarizes all of this information. It tells you how much you earned during the year, how much federal income tax was withheld, how much state income tax was withheld, how much Social Security tax you paid, and how much Medicare tax you paid. When you file your tax return, you'll use this information to determine whether you've already paid enough taxes or whether you'll receive a refund or possibly owe additional tax. You'll use this information when filing your tax return. Now let's compare that to a 1099. A 1099 is generally used for people who aren't traditional employees. For example, freelancers, independent contractors, Uber drivers, DoorDash drivers, graphic designers, or tutors who work for themselves. One important difference is that taxes usually aren't automatically withheld from a 1099 income. That means if you're self-employed, you're generally responsible for setting aside money throughout the year to pay for your taxes. Many first-time freelancers don't realize this and spend all the money they earn, only to be surprised by a tax bill later. So make sure that isn't you. Many people think the government waits until April and suddenly asks for money, but that's not how it works. Each paycheck usually has taxes automatically withheld. When you receive your paycheck, you'll probably notice that the amount deposited into your bank account is smaller than your salary. That's because some money has already been withheld for taxes and other required payroll deductions. Think of it as making payments towards your tax bill throughout the year. Too much, too little, or about the right amount. Probably about tax brackets. You've probably heard someone say, I don't want to raise because it'll put me into a higher tax bracket. That's actually not how tax brackets work. The United States has a progressive tax system. That means that different portions of your income are taxed at different rates. For example, imagine the tax system looked like this. The first $10,000 you would get 10% tax, and next $40,000 you get 12% taxed. If you earned $50,000 in one year, you wouldn't suddenly pay 12% on all $50,000. Instead, the first $10,000 is taxed at 10%, 12%. Getting a raise does not make all of your income taxed at a higher rate. Only the portion that falls into the next tax bracket is taxed at a higher rate. That's why earning more money always means taking home more money, even if part of it falls into a higher tax bracket. You'll often hear people talk about deductions and credits. They're not the same thing. A tax deduction reduces the amount of your income that's subject to tax. For example, if you earned $40,000 and qualified for a $2,000 deduction, you would generally be taxed as though you earned $38,000 instead. A tax credit works differently. Instead of reducing your taxable income, it directly reduces the amount of tax you owe. For example, if you owe $1,000 in taxes and qualify for a $500 tax credit, you would only owe $500. Because credits directly reduce your tax bills, they're often more valuable than deductions of the same dollar amount. Many people love getting tax refunds, but what exactly are they? A tax refund is not free money from the government. A refund usually means you paid more taxes throughout the year than you actually owed. Imagine your final tax bill is $2,500. Throughout the year, your employer withheld $3,000. Since you paid $500 too much, the government sends that $500 back to you. On the other hand, if only $2,000 was withheld, you may owe another $500 when you file your return. Every year, you'll gather documents like W-2s, 1099s, and other tax forms that apply to you, and then you'll prepare a tax return. Many people use tax software because it walks them through the process step by step. If your tax situation is simple, filing may be easier than you expect. If your taxes become more complicated, perhaps because you own a business or have a significant investment, you might decide to work with a tax professional. The important thing is to file on time and keep copies of your tax documents. Some common mistakes young adults make include waiting until the last minute to file, throwing away important tax documents, forgetting to report all of their income, assuming they don't need to file because they're a student, not updating their address or bank information, spending all of their 1099 income without setting aside money for taxes, and believing a bigger refund means that they made more money. One of the easiest ways to avoid problems is to keep all of your tax documents organized in one folder throughout the year. Taxes may seem intimidating at first, but once you understand the basics, they're much less complicated than they appear. Remember these key takeaways. A W-2 is generally for employees. A 1099 is generally for independent contractors and freelancers. Tax brackets don't mean all of your income is taxed at one rate. A tax refund usually means you paid more tax during the year than you ultimately owed. Deductions reduce your taxable income, while credits reduce your tax bill directly. Filing your taxes on time and keeping good records can save you money and unnecessary stress. As you continue your financial journey, understanding taxes will help you make smarter decisions about your career, your investments, and your money. Thank you so much for listening to Personal Finance Simplified. If you enjoyed today's episode, be sure to subscribe so you can never miss a new episode. I'll see you guys next Wednesday.